In the third module of the section devoted to the IFRS framework, we shift our focus to the qualitative characteristics of financial information, the second of the four main areas which the framework attempts to address and provide guidance for. Qualitative characteristics can generally be thought of as those attributes which make financial information useful from the perspective of fulfilling its declared objective. The framework identifies two kinds of qualitative characteristics: fundamental and enhancing. Fundamental qualitative characteristics are composed of just two items: relevance and faithful representation. On the other hand, enhancing qualitative characteristics constitute a more varied collection comprising comparability, verifiability, timeliness, and understandability. Let us begin by discussing the two fundamental. Financial information is relevant if it is capable of making a difference to the decisions made by its users. Please note that for information to be relevant, it does not need to impact the decisions made by all users. It is sufficient that only some of the users are influenced by the information for it to be deemed relevant. With reference to the relevance of financial information, the framework introduces the concepts of predictive and confirmatory value. On the one hand, if information has predictive value, it helps users predict a company's future performance. On the other hand, if information has confirmatory value, it provides feedback about how accurate past evaluations of performance actually were. The financial statements of a publishing company reveal that its revenues from online sales for the year amounted to €50 million. How would you qualify this information? What kind of value does it possess? If you are inclined to answer that this information has both predictive and confirmatory value, you are absolutely correct. On the one hand, the reported revenues can be used to predict future online sales, providing predictive value. At the same time, they can be compared against previous predictions made in respect of 2016, which is an obvious instance of confirmatory value. At this point, it is important that we also introduce the concept of materiality, which is very much linked to the notion of relevance. Information is considered material if omitting or misstating it could influence the decisions of users of financial information about a specific reporting entity. You can therefore think of materiality as an entity-specific aspect of relevance that should be looked at in the context of an individual company's financial statements. The second fundamental qualitative characteristic, named in respect of financial information, is faithful representation. After all, if the declared goal of financial reporting is to provide information about the reporting entity that is useful to existing and potential investors, that information should faithfully represent the financial situation and economic performance of the company. To the framework, faithful representation is associated with all of the following characteristics. It should be complete, meaning it should include all necessary descriptions and explanations. It should be neutral, in other words, free from bias, meaning that it should not be manipulated or phrased in such a way that it is received and interpreted in an unduly favorable or unfavorable manner. It should be free from error, but taking note of the materiality rule, it is important to stress that information presented in financial statements does not need to be 100% accurate in all respects. In fact, on many occasions, it will actually be impossible to provide accurate information, as is the case with various accounting estimates, for example, those made in respect of provisions. Let us now examine two pieces of financial information to see how the concept of faithful representation ought to be interpreted. Example number 1. The following information is presented in the notes to the financial statements. During the year, the company established new foreign subsidiaries, with no further mention of the subsidiaries in other parts of the report. Let us assume that the reporting entity did in fact establish 5 subsidiaries. Therefore, the information provided is definitely free from error. We can also state that it is neutral, as there seems to be no intention to influence the reader's interpretation of these facts. However, it cannot be said that the information is complete. There is no mention of the number of subs established or the countries in which they were set up. Lacking the necessary descriptions and explanations, this piece of information is clearly incomplete and therefore does not possess the key fundamental characteristic of faithful representation. Let's move on to the second example and another piece of information coming from the financial statements. In the past year, revenues from online sales amounted to €1.25 million. This represented an increase of 25% against the previous year and resulted primarily from growth in the books segment. The increase in sales is further analyzed and elaborated on together with a description of the company's new online strategy. Let us assume that the company really did register 1.25 million in revenue, but expressed in US dollars, not the euro. This piece of information could therefore be described as complete, as the data presented seems to be detailed and useful. There is also no suggestion about the statement being constructed in a way that unduly influences the perception of readers, so the information is clearly neutral. However, it is open for discussion whether it is free from error. Depending on the exchange rate between the US dollar and the euro, the discrepancy between what really happened and the information presented might be bigger or smaller. Nevertheless, some readers might be inclined to take economic decisions that they would otherwise not take. This example should also be analyzed in the context of its materiality. We can now proceed to discuss the second group of qualitative characteristics of financial information, that is the enhancing characteristics of comparability, verifiability, timeliness, and understandability. Comparability may be interpreted in two ways. First, the financial statements of one entity may be compared over time in order to identify trends in its financial performance. And second, the financial statements of various entities may be compared in order to evaluate their relative performance. These forms of comparability may be achieved using two important tools: consistency, which refers to the use of the same accounting treatment for similar items, either within a single reporting entity or in a single period but across entities; and disclosure, which refers to the fact that companies are required to disclose various pieces of information, including the accounting policies which they employ in the preparation of financial statements. The verifiability of information, the second of the enhancing characteristics, means that financial information should be capable of being confirmed. This may be done either directly, as is, for example, the case with cash reported, which may easily be counted, or indirectly, as would be the case with the carrying amount of a financial instrument reported at fair value, where the fair value could be based on the application of a valuation model. In order to verify the instrument's carrying amount, the inputs to that model and the formulas embedded in it would need to be checked. Next up, we have timeliness, which relates to making information available to users in time for it to be capable of influencing their decisions. Generally, the older the information, thus, after all, would you use financial statements from 2010 when deciding on whether to invest in a company in 2016? Probably not. And finally, we come to understandability, the last of the enhancing characteristics, which comes from the observation that some economic facts can be inherently complex. However, excluding difficult information from financial reports would make them less useful or even potentially misleading. There, the information contained in the financial statements is assumed to be prepared for users who have a reasonable knowledge of business and economic activities and are able to review and analyze economic information diligently. When applied, all of the characteristics discussed naturally increase the quality of information presented in financial statements. At the same time, however, the authors of the framework are also conscious of the cost constraints under which most companies operate. After all, information of the highest quality does not come for free. There is a lot of effort involved in collecting, processing, verifying and disclosing financial information. If these costs are high, then at least some of the users of financial information, namely the shareholders, are price of securing and delivering that information in the form of reduced returns.